All right, thank you. Yeah, appreciate it. Thank you, Jeff. And I'd like to also say thank you to Landmark Bank for having us, Jeff in particular, and Laura for setting this up. I really appreciate it, and I'm glad you did mention the wine and the alcohol, because we are probably going to end up giving about 12 of these presentations over a 3-week period. This is the first time alcohol has been served at one of these, so I'm really excited about the questions that we're going to get. Because if tax law doesn't get you excited before, tax law and wine probably should. That's a good combination. But yeah, see again, you haven't had that enthusiasm yet. We haven't even started. Yeah, that's right. Won't be the last. Yeah, so again, we're happy to be here today. Really, what we're wanting to talk about is we want to go through the tax bill. As we've been explaining to people, really what we're going to do is we're going to go through what changed, typically from a business standpoint for individual clients. We'll touch on estates and trust. We have something that relates to estate and gift. We really won't spend a lot of time on that. But we're really going to touch on it in 2 different areas, I think, if you think about it, if you look at the focus on this. One, we're going to talk about, what changed in the bill. And when we see this, we're going to see that there are a lot of challenges associated with this tax law. Don't want to, underscore that or, maybe overlook that too much. This was a major piece of tax legislation. It was a major piece of tax legislation that was passed in a relatively short period of time. There are going to be challenges associated with this bill, be it as it relates to implementation, as it relates to interpretation, or the fact that we maybe don't have proper interpretation, yet on some of these items. So that's one. Again, not shying away from the challenges associated with it, but recognizing the fact that there are challenges. Now, having said that, though, our job is to help mitigate those challenges so they're not surprises, to you and your businesses. In addition to that, though, even though we see that there are challenges, the second thing we want to accomplish is maybe look through those challenges a little bit to understand that there are opportunities also associated with this tax bill. Anytime we have a new piece of tax legislation as well, there are new opportunities for planning, particularly as we have kind of a bright line cutoff between the old, law and the new law. So again, recognizing the challenges, but being able to look through those and hopefully then find the opportunities associated with it. So as we begin, kind of maybe to set the stage on this, we want to look at, what did they hope to accomplish? I think it provides some context. It may even provide some humor a little bit later as we get into some of these rules. Inadvertent humor, I will grant you. But they said, what did the tax reform bill hope to accomplish? And, there were a number of things that were mentioned, but we've really boiled them down to 2. The first of which was a lowering of tax rates. And I think we can say in this respect they were successful related to this. Generally speaking, for most levels of income, for most taxpayers, be they business or individual, tax rates, at least the tax rate brackets have gone down, or the income thresholds to get to those tax rate brackets are a little bit higher than what they used to be. That's easy. Now, what we're going to see, though, is certain things had to be given up in association with this. So we would see lower tax rates, but maybe we had simplification, which we'll talk about here in a second, or an elimination of quote-unquote tax loopholes, or just any number of things that maybe, make other changes to the tax code that may mitigate some of those tax rate reductions that we're going to talk about. But again, generally speaking, I think we can say that lower tax rates, they hit that. The second item is simplification, and this one I think is a little bit more questionable, or maybe a little bit more complicated, all right? Because as we'll see, in certain respects, the tax bill simplified things. And I'd say generally, if your tax, if your tax return or your tax situation was simple before, it probably got a little bit easier under the bill. But the world that you live in, the world that we live in, as it relates to small business, I can assure you, as soon as we get talking about this, it'll be obvious that they appear to have missed the mark as it relates to simplification, particularly as it relates to business owners. Now again, I don't want you to lose sight of the fact that there are opportunities associated with that and benefits that can be had, but to say we receive these benefits and simplification of the tax code, I think we'll see probably isn't accurate. So what we hope to accomplish today really is to look at what we call, really look at this in 3 different areas, or for 3 different groups of taxpayers. So Laura's going to help us first. We're going to talk about business taxpayers and generally the impact on businesses. Now the one thing we want to draw your attention to as it relates to those changes is that for business taxpayers, unless we state otherwise in the slides or in the materials, those changes are typically permanent changes to the tax code. Now again, changes to the tax code are only as permanent, until such time as the legislature decides to change them. but they don't sunset, they don't expire, and generally speaking. It's a little bit different on the individual side. The provisions related to individual taxpayers, and that also includes our flow-through business owners, those generally speaking, unless stated otherwise, expire, they're sunset. December 31st, 2025 generally is when those tax law changes expire. Again, unless otherwise stated. So we're back to the Bush era tax cuts. We had the similar thing with them. We've got tax cuts for a period of time, a stated period of time, and then after that, barring any legislative action, we go back to the old law. So again, that also is going to provide some complexity for us as it relates to from a planning standpoint. And if history is our guide, the other thing that will likely complicate this is Congress will most likely get around to dealing with these expiring provisions sometime around December of 2025. I think if we're lucky, possibly January of 2026 made retroactive. It's just the way things go. Finally, like I said, we'll talk about estate and gift. We won't spend a ton of time on that one, but the one thing to keep in mind related to that, particularly for those of you who may also, advise on the estate and gift side, those changes are temporary. Those are set to expire on December 31st, 2025, just like the individual changes. So that's really the kind of the template for what we're going to talk about at any time. And again, I think probably the wine and beer may facilitate this a little bit. But if you guys have questions at any time, please do not hesitate to ask us anytime we're talking tax law. It always goes a little bit easier if we have a little bit of a give and take and it's not just us up here talking about it. Maybe it's a little less depressing that way. All right. That having been said, so that is how we're going to do this. That's kind of the framework. Laura, then, I'm going to turn it over to her. She's going to take us through some of the business changes. Excuse me.
All right. So, like Jeremy said, these are going to go through some of the business changes that we have. Bear in mind, Jeremy has given this presentation about 8 times. This is my first. So I do invite him to have any other comments that I may exclude, that he chime in if there's anything else. And like he said, if there are any questions going through any of these, please feel free to ask mid-presentation. It's probably more relevant at that time anyway, but questions are welcome at any time. So the main thing for the business taxpayers, the first one is the corporate tax rate for C Corp has been lowered to a flat rate of 21%. I would assume that most individuals in this room as business owners aren't organized as a C Corp, but it has just decreased to a 21% flat rate beginning in 2018. It has repealed corporate alternative minimum tax, and that is the corporate alternative minimum tax, not the individual AMT. So individual AMT has remained in place. And then it has eliminated most of the NOL carrybacks, which it used to be you could carry NOLs back. You can no longer do that. You can now carry them forward indefinitely. It used to be carry them forward 20 years. Now you can carry them forward as long as until the NOL is no longer there. However, they have put a limitation on that to 80% of the taxable income associated with that. So you can never fully come down to a 0 taxable income. So anytime that you have an NOL, you can use a portion of that year, but you could never you could never bring it down to 0 if you had an NOL that was that large. For NOLs that are currently in existence, that too, you can no longer carry them back. They will still only be going forward. So it's not just those NOLs being created currently. It is already those NOLs that you may have in place. And then there were a lot of changes to fixed assets and expensing of those purchases. We now are able to immediately expense 100% qualified property for assets purchased and placed in service after September 27th, 2017. This is one of the only pieces of the legislation that is retroactive to 2017. So when you're doing certain tax planning now with your advisors, it's something to look at, that if you had any fixed asset purchases in the fourth quarter, that some of those purchases could be fully expensed through bonus in 2017, which had been 50% and is now up to 100%, and that has changed to apply to both used assets and new assets. It has to be new to you. It doesn't have to be a new asset, which used to be the rule that was in place. And then the Section 179 expensing limits have been increased to $1 million with a phase-out threshold of $2.5 million. So it's just, and that used to be 510,000, I think, was the 2017 limit. So it's basically doubled those thresholds for the Section 179 expensing. There were certain deductions and credits. Yes, sir.
Yeah, question.
Yeah, absolutely.
C corp, what about an S corp?
These were in the place for all businesses. So this is not specific to a C corp. The one piece of this that was specific to a C corp was that 21% rate. And we'll get to, we kind of rolled in the S corp rates and things related to that into the individual conversation that Jeremy will discuss later.
Right.
Yeah. Good question. Yeah.
Okay, so we repeal or modify various deductions and credits. So the domestic production activities deduction, which used to be for those manufacturing in the United States, was a 9% deduction, basically off the bottom line, and that has gone away, and that is for both all business entities. So it has been replaced with a different deduction, which is part of the flow-through, which is a 20%, which Jeremy's going to discuss later. But the corporate reduction in rate also makes up for a bit of that. So that used to be 9% off the bottom of your bottom line. That is no longer the case. It has been completely repealed. Research and R&D expenditures have to be capitalized and written off over a 5-year period. And business interest deduction is limited to 30% of the adjusted taxable income. So your interest expense that you're recognizing can't be more than 30% of your net income. And then, so this is kind of a big one that people have been asking questions about is meals and entertainment. So entertainment expenses starting in 2018 are no longer deductible in any instance. So before, if it was client entertainment, then it was 50% deductible. That is no longer the case. Meals for the benefit of the employee, still 100% deductible. And then those client meals, we're kind of seeing a little bit of going different directions on that. So maybe Jeremy has a little insight.
The insight is it's unsettled, to say the least. As it relates to business-related entertainment expenses, yeah, completely non-deductible. That's clear. For the benefit of employees, for the convenience of the employer, those actually will become 30 or 50%, and then eventually non-deductible. But we still have that. As Laura rightly said, the problem is we have meal expenses that otherwise may have been associated with entertainment. So the question is whether or not those are deductible, and you hear different things from different people as it relates to those. If you look at the committee report related to this bill, and I would advise none of you read that because I just met you, but I like you. I know I like you, so I would never tell you to do that. They state that business meals that are necessary related to the operation of your trade or business are still deductible at 50%. But the example they use, for example, meals associated with business travel. The problem with that is that is the absolute most obvious example they could have given us. I don't think any of us would have said that those were non-deductible. So we know those are deductible at 50%. But, you know, Laura takes a client out to lunch. They talk business the entire time, but that's all they do. There's really no entertainment aspect to it. Is that lunch?
Pretty entertaining.
Yeah, you're right. Yeah, yeah. That notwithstanding, that's right. Yeah. You know, then is that meal deductible or not? And it depends. Under the old regulations, they say that food for the benefit of clients or customers and their families may be entertainment. And I'm using scare quotes and air quotes because that's what they do in the regulations. But the question is if it's entertainment, it's non-deductible. If it's meals necessary to operate your trade or business, it's 50% deductible. And if you put a gun to our heads and asked us which one it was, I'm not sure either one of us are in a position to say which it is. So more guidance will have to be forthcoming. But yeah, if you guys have any questions, yeah.
Well, did you say that meals for employees are also only 50%, not 100 anymore?
They did move. They did transition, and the problem with that though is they are temporarily at 50, and then in 2026 they go to completely non-deductible.
Unless they change it, of course.
Unless they change it, of course, right, which I don't know that anyone was clamoring to get rid of the meal deduction for the benefit of their employees. I mean, I think what we see on this is, and you can correct me if I'm going to editorialize a little bit on this. I think they wanted to get to the 21% tax rate on the corporate side. That was the big issue, right? So let's get to 20% or something close to that. They did. A lot of these are levers, I think, that were probably pulled either A, to get the votes in the Senate, or necessary to sort of meet the budgetary requirements so they could stay under the limitations to, so they only needed the 51 votes. And so it just may have been an issue where, they were, with the 50% haircut, that was the whole point, was you didn't have to decide meals or entertainment, you just take a haircut on it. It may have just been something, it just may have been a revenue raiser, frankly, in this bill in order to help it make budget.
And so how are they going to decide? Are they going to look at each one by a case-by-case basis? Or
In a perfect world, we get regulations, right? I mean, they'll have to issue, like they do for the tax code, regulations, which give a little bit more color, a little bit more guidance to the tax code. The problem is, though, that's what happens when you pass tax legislation in December. The IRS is now, like we are, into busy season. And they tell us that the IRS, and I know the IRS is understaffed. So how quickly will they get regulations? I said, well, I made the comment the other day, 4 to 6 months, and one of our other partners just kind of laughed and said, yeah, that would be record time in a normal situation. But we hope to get some type of guidance on it during this year. They're supposed to do we need a technical corrections bill, because things they say the bill does, it doesn't do. Even though it tells us it does, if you go to the code, they just made a mistake. Well, I don't know when I hear that that's not, they can't get a technical corrections bill through. So I don't know when we'll get guidance. Like I said, it's not always the most uplifting of presentations, but yeah.
So what would you recommend we do when it comes to, especially employee meals?
As it relates to employee, the record keeping is going to be key, right? So to the extent you have something that is obviously an entertainment expense, tickets to a ball game that you would take clients to, for example, categorize that, make sure your accounting system categorizes that one way, because we know that's non-deductible. Meals on premises for the convenience of the employer, for the benefit of employees, code those separately, because we know those are deductible. They're not deductible in the same way as they used to be, but they're still deductible. All of those other meals, I think for the time being, I would probably code those to other just general meal and entertainment expense, potentially subject to 50% deduction, potentially non-deductible. But at least you're not bunching 50% meals and entertainment with entertainment that is 0% deductible. That's the best practice. I don't know if that's it's helpful to an extent until we get regulations. That'll be the biggest help we get. But I would definitely I think we would recommend being very careful about how you categorize those. Because otherwise we will be asking you those questions when we look at the return. Okay, what makes up that meal and entertainment expense? And trust me, doing it now versus having us bug you about it, next spring, for example, and having to go back in and dig through those records. Nobody wants to do that.
And I've had the question before too. It should be clarified that it's still a business expense for your business. It's just not tax deductible.
Yeah.
So, actually running those expenses through as business expenses isn't an issue. That should still happen. As it's an expense that you're putting. If you weren't in business, you wouldn't be having those expenses. So it is still a business expense that you have, but the tax deductibility of it is just in question. Okay. All right, so there were repeals or modifications to some deductions and credits for business taxpayers. This one was a specific one that was in there for employer-paid family and medical leave. It is temporary. It only applies, yes, sir.
Can we back up for a second?
Yeah.
My feeble mind.
No.
I apologize. I deal with pictures all day. But when you say the meal thing, you're talking about expenses. Well, it's still a business expense, but it's not deductible. Does that mean that it reduces our profit?
Yes. It would reduce your profit for your net income that you're going to show in your books.
What we made and what we pay tax on is small.
Small. Well, it's going to make what you pay tax on larger. So we do adjustments at the end. So we take your net income basically that you've made. You've got so much income, so many expenses, we get to a net profit. And then, so we're going to take that net profit and then say some of these meals and entertainment aren't tax deductible. We're going to add that bit back just for tax purposes. So we're going to put that on your tax. So it's going to be an addition.
Counted as an expense, then, business expense. You were confusing me when you said it is business expense, but in fact doesn't lower the taxes. My understanding is we just pay taxes on our profit, net profit, right?
Yeah. So it's your taxable income is going to be a little bit different than your book income that you have, your business income.
It's a fine
Yeah.
line distinction.
Yeah.
So it's still a legitimate business
Business.
expense. You're doing it for the purpose of your trade or business to try to
That just means
take care of your
nothing though when
customers.
it comes to tax.
It could be-
Yes.
It just
Yeah.
means-
Yes.
It just means it's a non-deductible.
Yeah.
So those of us who are simple, we don't refer
It's
to
a
that as
non-deductible
expense.
business.
Yeah.
Yeah.
So whether you pay for it out of your personal pocket or whether you pay for it out of your corporate checkbook or whatever, really doesn't matter from a tax perspective.
Yeah. Maybe put another way, if you have a business, all right, and you're a business owner and you have an expense, if it was a personal expense, it's not going to show up on your financial statements as an expense. It's probably a distribution to owner. So as Laura said, yeah, it's a financial statement expense. So it's the worst of both worlds. It reduces your taxable income from a financial statement purpose, reporting purpose, just as non-deductible.
Good question.
Yeah.
Complicated question.
Yeah, this is by far the thing we've probably received the most feedback on, without a doubt. And they could have avoided all of this by just not messing with it, but yeah.
Yeah. Were there any other questions on that last slide? Please feel free to. Okay. All right, so employer paid family medical leave. Like I said, this one, we said most of the business rules were permanent. This one is temporary. It only applies to 2018 and 2019. And the credit is equal to 12.5% of the amount of wages that you've paid to that employee while on leave. You have to pay at least 50%, and that credit is increased by 0.25 percentage points, not above 25% for each point the rate payment exceeds 50%. So if you were to pay 100%, then you would get you could get up to that 25% credit for those wages paid.
Okay, sorry.
That's okay?
Yeah.
That doesn't make any sense to me. So if I pay, let's say I have someone on maternity, I pay 100% of their wages.
Yes. So you would get, so the credit is equal to, so it's 12.5%, and then it's increased by, so you get 12.5% on the first 50%, and then the second 50%, it is 25% per the 50, so which comes out to another 12.5.
Yeah, you get a straight 25%
5%.
if you pay them at 100%.
So in other words, you
Credit.
don't get a full deduction for.
You don't get well, you get the full deduction plus you get a tax credit, which is a dollar for
Yeah,
dollar
you get the
reduction.
deduction.
Yeah,
So
the
you get-
deduction is.
If you paid her,
Yeah.
$15,000,
Yeah.
you get that as an expense, the $15,000 of wages paid, and then an additional 25% of that $15,000 would be a credit, like to your tax liability,
Okay.
dollar for dollar
Yeah,
Okay.
reduction.
Thank you.
yeah.
That makes sense.
It was almost too positive for a second, wasn't it?
Yeah.
You did, it was not registering. Yeah.
Okay, so there was the accrual method. Taxpayers recognize income no later than the tax year in which the item is recognized as revenue on an applicable financial statement. So this was to get for income recognition more in line for GAAP purposes with tax purposes. And
I think that mostly codified some law that was case law that was already there. I don't think that'll have a big impact. The next one will probably be a little bit more impactful given that just its simplification.
And this one, it raised the limit. So method simplification for businesses with average annual gross receipts of 25 million or less. This used to be, the threshold was 10 million. So they've increased that threshold by 15 million for these items. So cash basis of accounting for corporations and partnerships with C Corp partners. Cash basis of accounting for businesses with inventory. So previously, if inventory was held and you were above the $10 million limit, you had to be on an accrual basis. That threshold is now raised to $25 million. For the capitalization of inventory, which is the letter C, that threshold also above $25 million. And then for any construction companies in the room, completed contract method versus percentage of completion. So those methods used to be required, or percentage of completion was required for anything over 10 million. Now it's over 25 million. And keep in mind, these were all for tax purposes, so it could be different for GAAP and financial statement purposes. Okay, and Jeremy will now speak a little bit on the individual side.
All right, any questions on any of that before we go on?
Yes,
we're going to get into happier territory, and then, yeah, so.
On the medical leave or maternity leave,
Okay, yeah.
what if the person is commission-based? So some pay
Oh.
and commission. Okay.
I don't know. I'm not sure. I'd have to look. I don't know the answer off the top of my head. Do you know? My guess is it's probably be based on base pay, but I don't know if there's an averaging that has to be done in something like that. And again, it may be that we don't know the answer, or that no one knows the answer yet. I'm not sure. It may be one of those items we need regulations on. But we can follow you. Okay, yeah, right. We'll follow up on that question. Can we get your information after, or we can send it out, and you guys can send it out as well to everyone. But yeah, we'll find out for you, because I'm not sure what the proper answer in that case is.
I have a
Right.
question on the completed contract method.
Yes.
What are you looking at for a long-term contract?
If it is a long-term contract, and so if you're under the 25 million gross receipts average for 3 years, it's contracts under 2 years. You could use the completed contract method for anything longer than that. You would still have percentage of completion, and so that would accelerate some of the recognition of income for tax purposes. But if it's less than 2 years and you're under those limits, you now can use completed contract. So 2 years is the threshold there.
2 years?
Yeah.
And it doesn't matter whether you're an SOC or...
No, it does not. Yeah, it's any type of business.
Right.
Yeah, any type. Good questions. Anything else before we move on? All right, so looking at those individuals, and again, since none of us are C Corps here, presuming everyone has a flow-through business of some kind. Either way, we're all individuals. We can say that. We're all individuals here. So we all pay tax at individual rates. So the good news is we didn't really get the simplification we thought we would get, in that, some of these prior versions of the bill had fewer rate brackets. We stuck with the 7. They stuck with the 7. I shouldn't say we. I take no responsibility for this. But generally speaking, the rates are lower. All right, so 10% was the lowest tax rate bracket, all the way up to 37. That used to be 39.6. Again, at almost every level of income, the rates under the new bill are, generally speaking, they're no higher than what they were under the old bill, generally speaking. There may be few brackets of income where that's not the case, but overall, cumulative, as you work your way through these brackets, if you're just looking at the tax rate brackets for basically every individual, your taxes will be lower at every level of income. Okay? One thing to keep in mind too, you may hear about the marriage penalty. The marriage penalty under these rate brackets doesn't kick in until that top tax rate bracket of 37%. What we mean by that is, if you look at the cutoffs for individuals, unmarried taxpayers, single taxpayers, and then look at the rate cutoffs for married filing joint, the married filing joint brackets are always double the individual, with the exception of the 37% bracket, which for individuals kicks in at income over $500,000. If you're married filing joint, you hit the top tax rate bracket at income over 6. But that's the only place where it is. One thing we don't mention on any of these slides, capital gains taxes. The preferential rates on capital gains, maximum rate of 20%, 15% for most individuals. The reason why we don't mention that, because it did not change. And generally speaking, it still is at the same income cutoffs that it was before. That's qualified dividends as well. In addition to that, net investment income tax, the Affordable Care Act taxes, like that 0.9% self-employment surcharge, the 3.8% net investment income tax, those they didn't get rid of those, they didn't kill them. They are still in existence, still at roughly the same income levels as what they were before. Okay? So that's why we don't mention them on here. So really, we've got these 7 tax rate brackets, plus we have to overlay all of those tax rate brackets on top of those, just as we always did. Now this next one I kind of made fun of simplification at the beginning of this talk. This is one area where they added simplification. May or may not be to your benefit, but they added simplification to the law. So what they did was they said, let's take a look at the standard deductions. We have standard deductions now and exemption deductions or exemptions. For a married filing joint taxpayer, for 2017, that standard deduction was a little over $12,000. What they did was they nearly doubled the amount of the standard deduction for all taxpayers. So if you're a married taxpayer filing jointly, that standard deduction is $24,000 going forward. However, they also eliminated personal exemptions. So that is, for taxpayer, spouse, and each child, unless you were, phased out because your income was too high, you received a deduction of approximately $4,000 per person. Taxpayer, spouse, and kid. So you can do the math. I've got 3 kids, but I was one of 6. You get enough people, that additional $12,000 standard deduction doesn't exactly make up for the lost exemptions in some instances. But that's okay in some instances because we've got item 3 up here. To sort of make up for the lost exemptions, which again we're trying to simplify things here, they increased the child tax credit. It was $1,000, it's increased to $2,000. There's a refundable portion on it. In addition to that, the threshold before you begin to phase out of that tax credit from an income standpoint has been greatly increased. So they've expanded the child tax credit both in amount and as well as the number of taxpayers or individuals that qualify for the child tax credit. But that doesn't mean everybody's going to win in this case. Because again, let's say you had a married couple that was already itemizing above the $24,000. So the $24,000 standard deduction doesn't do them any good. Let's say they maybe have a child or 2, but those children are in school, but they're over 17. Well, now since they're over 17, they don't qualify for the child tax credit, so you're not, maybe if you got the exemption from them previously as students, you're not getting the additional child tax credit now. So you're actually losing out on those exemptions and not really gaining anything on the standard deduction side. Now, I'm not saying those individuals are going to pay more tax. We still have the lower tax rate brackets to deal with that we saw on the previous slide, but their reduction in tax may not be as great as what we would otherwise think it would be because we give some of this back in lost standard deduction or lost exemptions. So just something to keep in mind. And as Laura alluded to earlier, as it relates to the alternative minimum tax, they couldn't kill it on the individual side, killed it on the corporate, couldn't kill it on the individual side. But the exemption amounts before you get into alternative minimum tax have been greatly increased. In addition to that, as we're going to talk about here in a second, itemized deductions are going to be limited. At least certain deductions are limited in ways they weren't before. Some of those are deductions that would have put you into alternative minimum tax. So given the fact that the exemptions for alternative minimum tax are higher, and we're losing some of those tax deductions that would have been added back for alternative minimum tax purposes, given the fact we're losing some of those, fewer people will be subject to AMT. So they didn't kill it, but it will more likely be a higher income taxpayer threshold, whereas in recent years you didn't have to make all that much money to fall into alternative minimum tax, but it's still there. Okay, itemized deductions. Spend a little bit of time on this one because they did make change. Congress giveth, Congress taketh away. We got lower tax rates, but they also made adjustments to itemized deductions. The first 2 of these are the good news. These are the expansions. Medical deductions. Historically, going into 2018, you could deduct medical expenses if A, you itemized deductions, and B, to the extent your medical expenses that you paid out of pocket for any given year exceeded 10% of your adjusted gross income. So you had to have this really nasty combination of lower income and higher medical expenses before you could deduct. That's still the case, but they lowered the threshold for deduction at least for 2017 and 2018, to 7.5% of gross income, down from 10. So this is, again, one of those few items that is retroactive into 2017. So medical expense is still here, deduction is still here, lower thresholds for 2 years. Charitable contributions. Generally speaking, if you gave cash contributions in any given year, the amount you could deduct in any given year was limited to 50% of your adjusted gross income. And then any amount above that you just had to carry over, and you would use it in future years to offset taxable income. They've increased that threshold to 60%. So we do have the ability to make greater contributions and get a larger deduction in any given year than what we did in the past. All right, so that's the good news. The rest of these are either limited or eliminated in some way. So let's take a look at mortgage interest. This is, again, one that's kind of interest to people, at least depending on what state you live in, too, you're probably more interested in it. Previously, you could deduct interest on the first $1 million of mortgage debt. And that's still the case. If the mortgage was in place, and this is on your qualified primary residence or qualified residence, if the mortgage was in place at the effective date of this bill, nothing has changed for you as it relates to your mortgage interest. Doesn't matter if it's a $1 million loan, you can still take the interest on it. However, for new mortgage debt that's entered into after the effective date of this bill, that threshold has gone down to $750,000. So we can only deduct the interest on the first $750,000 of mortgage debt. The other thing to keep in mind is if you refinance that existing debt, as long as you don't refinance for an amount greater than the original debt, it is also grandfathered in. Okay, so that's the good news. If you have home equity interest, and we're talking about what the IRS refers to as home equity interest, so it's debt against your home secured by your qualified residence, but the proceeds of which are not used for the qualified residence. Maybe they pay for education expenses. Who knows? But it's secured by the primary residence. That has been deductible in the past up to debt of $100,000 as it relates to that type of debt. That is no longer deductible. Nothing is grandfathered in as it relates to that. So what the IRS referred to as home equity indebtedness, we can no longer take a deduction associated with that. Now, that's not the same thing as saying, well, a home equity loan is non-deductible. If the proceeds of that home equity loan are used to purchase, improve, or build a residence, that interest is still deductible. So we just have to look at what the use of the funds are in order to determine deductibility. It's mortgage interest. Number 8 is the interesting one. This is the one that's going to cause us some heartburn as business owners, as advisors, state and local income taxes. Historically, those have been deductible to you without limitation, assuming you're not an alternative minimum tax. Beginning in 2018, you take your real estate taxes, your personal property taxes, your state and local income taxes. On the individual side, and again, let me clarify something because I've about put 2 people into cardiac arrest this week related to this comment. If you own a business and the business pays real estate taxes and personal property taxes, those are deductible business expenses, still deductible to the business. They don't hit your itemized deduction schedule. They don't hit your Schedule A. So those are still fully deductible. But personal property taxes, personal real estate taxes, and then state and local income taxes. And unfortunately, that also includes state and local income taxes on income earned by your flow-through business that flows through your personal return. The deduction for those is capped at $10,000. Right, we've got business owners that are paying tax on their business income because they're owned in flow-through entities. They were likely paying more than $10,000 in state and local income tax. Their ability to take those deductions is now limited in ways that it hadn't been before. So again, their overall tax rates may be lower, but they may be giving up some deductions they had in the past, thus raising their effective rate higher than what it otherwise would be under the law. And that's something that's probably going to have a relatively significant impact. Having said that, most people I think will still be lower. They'll still pay less tax, but it may not be as big of a difference as what you might think based upon the tax rate brackets. Yes.
You might have mentioned this, but so if it's investment property owned in an individual or a couple personal names, does that go against the 10,000 or is that considered business?
That would have, I think the individual side, is that what, I mean, it would have, if it's investment property.
If it's on a Schedule E,
well, yeah,
even if it's held in the personal name, wouldn't it?
That's a good point. If it's something you're just holding for investment, if it doesn't show up like on a, because Laura said, if it's on a Schedule E or on a Schedule C or on a Schedule F, it's deductible on all of those schedules. You're fine. If it's just...
E1, even if it's owned in your personal name,
yes.
it would still be deductible, or not captured.
Yes, exactly. Yeah. Good clarification. Yep. Yeah, anything related to your business is still deductible under the old rules as it relates to real estate taxes and personal property. Yeah, I had somebody that paid a significant amount of real estate tax in their business, and I said this and didn't clarify, and he just about hit the table. We about lost him. So thank God we got that cleared up. I don't want to be responsible for killing anybody. Yeah, there you go. You noticed that. Dang it. Yeah. All right, so anything else with state and local income tax? Yeah.
Well, I have a question about the charitable contribution.
Okay.
Do you know if that also applies to services donated? Like if you're a service-based business and you donate a service to a nonprofit?
Like an in-kind. I don't think any of the rules changed related to that.
Okay.
You know, I mean, there was nothing that changed it. If it was deductible before, it's deductible now. The only thing they changed was just the cash deduction limitation, the threshold. All right, miscellaneous itemized deduction, investment fees, tax prep fees, unreimbursed employee business expenses. Gone. Completely non-deductible beginning in 2018. But because they did all of this, there used to be a limitation for higher income taxpayers. As you reach certain income levels, your overall itemized deduction was limited. They did get rid of that limitation, okay? Given the fact they had these other limitations put in. All right, any other questions on itemized deductions before we move on to what is undoubtedly Laura and mine favorite section in this entire presentation?
About mileage.
Unreimbursed business mileage, if you're an employee, no longer deductible. If it's reimbursed by the business, you know, you're going to pick it up in income potentially, and it's not subject to the deduction. Or yeah, you're going to pick it up in income, it's not subject to the deduction. The business can deduct it if they reimburse you. But if it's an unreimbursed business expense that you would have taken an itemized deduction for, it is no longer deductible. Again, I don't think anyone was clamoring for simplification in that area, but that's what we got. All right, pass-through businesses. We've already, determined we have no C corporations in the room, so I imagine we've got a lot of, whether it's sole proprietorships that file on a Schedule C, Schedule E, Schedule F, rentals, farm, or just regular trade or business, S corporation owners, partners in a partnership, or members in LLCs taxed as either S corporations or partnerships. They do not get the benefit of that 21% tax rate. So to add a little bit of parity to the tax law, they said we're going to put a deduction in this bill related to income from pass-through trades or business. That deduction simply is a 20% deduction on the net trade or business income from a pass-through entity, and that also includes a sole proprietorship. Right?
What's a pass-through?
Pass-through, are you an S corporation owner, LLC member? The income from the business flows through to your personal return, or you just own it in your name. They use pass-through, but it's any of those businesses. If the income from that business shows up on your personal tax return, it's subject to this. Yeah, good question. So 20% deduction against that income, and you do that calculation for each trade or business. So far, so good. There's a catch, because there's always a catch. There's also a limitation on that. Generally speaking, the deduction is 20% of your net trade or business income on a trade or business basis, but it's limited to the lesser of that or one of two items. 50% of the W-2 wages, or your allocable share of the W-2 wages that trade or business pays its employees, or 25% of the W-2 wages that trade or business pays, plus 2.5% of the adjusted basis, or the original cost basis of the assets, the fixed assets of that business, equipment, real estate, for example. Simplification, right, guys? It's easy.
Could you give an example of that?
Yes. So let's say your business, let's say you're the sole owner of an S corporation. You're the only owner. Your business has net income of $100,000 that flows through to your personal tax return. 20% of the $100,000 is a $20,000 deduction. So far, so good. But let's say that business only pays $20,000 of W-2 wages. Your allocable share of the W-2 wages as 100% owner is $20,000. So then we have to say, okay, your deduction is the lesser of 20% of your net income, which is $20,000, or 50% of the W-2 wages that the business pays, which is $10,000. You get a $10,000 deduction.
Unless you have.
Or let's say it's a real estate business and you have no W-2 income, but you've got a significant amount of fixed assets. Then you do the 2.5%. And if that's better, in other words, if you have significant fixed assets, maybe that plus 25% of your W-2 wages, maybe that's a higher amount. You know, we just have to do that optimization calculation to see what's best. But if 50% of your W-2 wages, if your business paid $50,000 of W-2 wages, half of that's $25,000, you get the $20,000 deduction, the original deduction. It's just not limited in any way at that point because you had $100,000 of income.
And that credit's just going to flow through then to that first page.
It is a deduction that's actually going to flow through to the second page. Oh, you're going to hate asking this question. It is a deduction that is not an itemized deduction, but it's not a deduction that impacts your adjusted gross income. So it's after the calculation of adjusted gross income, but prior to the calculation of itemized deductions. And the reason they did that, for example, the charitable contribution limitations based upon 60% of adjusted gross, this doesn't reduce that. That's the good news. But they've now created a different category of deduction. It's not above the line. It isn't against adjusted gross income, but it's not an itemized deduction. And it's also, it's a deduction, not a tax credit as well. So that's some prior versions, it was a credit. I think that was even worse than this. Not that this is good. I mean, it's beneficial. That's it. It's beneficial to our businesses. But it comes at the price of simplicity. That's the cost. All right. Yes, question.
So, this is the first time we've kind of come to a little bit of a wall here with all this individual. So my question is in your experience, if you were to take a customer that you had last year and you do their taxes, and you can have a customer, same customer, you're going to do the taxes this year, nothing changed in their business. Overall, does your instinct tell you that this right here is going to change kind of the landscape of their return, their Schedule C, well, as it affects their personal, very much?
Potentially, yes. I mean, that's kind of I know that's a weasel word answer. I said potentially. But no, it will. You know, you're going to have to do this calculation for everybody, unless, for example, I mean, it's just obvious they pay no wages, they have no fixed assets, and it's pretty easy. But if you can get a 20% deduction against that income, at a 37% tax rate, you know, let's say they're in the highest tax rate bracket, you get a 20% deduction against that income, that is, we'll show the math a little bit later, that's an 8% reduction in tax that they otherwise would have paid. So that's big. So that's what we don't, you know, we make a lot of jokes about the itemized deduction, state and local tax, they didn't simplify anything. We're going to give some of those tax savings back. But if you can qualify for this, you know, it's complicated. We like to laugh about it, like, oh my God, who wrote this? Who drafted this? But there will be a benefit. It'll be a significant benefit, assuming you don't run afoul of these rules, which, question.
So as in an S Corp, is that a 50% of all W-2s paid out? So
yes.
All employees of W-2s collectively, or just that individual?
All W-2s paid by the business. And it is W-2 income. So if you pay independent contractors, doesn't count. If you pay a management fee and they do the payroll, doesn't count.
Not of the owner's W-2s, but of all?
All of the businesses. And it is your pro rata share. So if you're a 50% owner in the business, they allocate to you. We'll have to show on the K-1 50% of the W-2 wages of the business. And then 50% of that. That's probably a bad example. Let's say you're a 70% owner. You'll show 70% of the W-2 wages, and then you'll take half of that for your portion of the calculation. See, this is why we said this is our favorite section. And we've just scratched the surface because they're, as I say on the infomercials, but wait, there's more. Yeah, before we get to that.
So, I fear that I'm asking the same question, but
no.
I can look at it from a different direction.
Yeah.
So, let's say my business makes S corp, pass through, I'm a single owner.
Yep.
S corp.
Okay.
I pay myself a W-2, or pay
Yes.
myself a salary,
Yep.
and then I take some draw, I balance it to manage my tax.
Yes.
burden.
Correct.
So, let's say I make $100,000 profit in the business.
Separate after you take the W-2.
After all wages have been taken.
Fantastic. Okay.
Okay, so I try to pay, so my W-2 income is still fully tax deductible.
Oh, you bet.
Oh, okay.
Yeah, this is after every other deduction you take. This is one of those that's a tax deduction that you wouldn't show in your financial statements. This is the opposite of what we were talking about earlier. But yeah, you'd take all of your wage deduction, everything else like you would before. Yeah.
Mine included.
Yours included.
Okay.
Yeah.
I was confused. I thought you said
No. Oh.
4%. I was misunderstanding.
No, good clarification. No, you still get to deduct your wages as a business owner like you would have before.
Is it whichever is lower? So a 20% deduction on income, but it's limited to 50% of the W-2 wage.
Whichever is less. Except, just been waiting to say this. If your income falls under certain limits, all of this stuff that we're stressing out about goes away. That's the good news. Now, we want our business owners to make as much as humanly possible, right? Everybody wins. But if your income is below certain thresholds, that W-2 limitation doesn't kick in. Oh my God, we killed the computer. Okay. Got sick of hearing me talk about this. Yeah, we're done. Okay, so if you're a married taxpayer filing jointly and your taxable income, now here's the catch. This is taxable income, so that includes all trade or business income, all W-2 income, all non-business income, investment income, less deductions, all of your itemized deductions, just your taxable income number. If your taxable income for a married taxpayer filing jointly is less than $315,000, guess what? We don't have to worry about the W-2 garbage, because then it's just a straight 20% deduction. That W-2 limitation, that 50% of W-2 or 25% plus 2.5%, those get phased in as your taxable income moves from $315,000 to $415,000 if you're married filing joint. If you're a single taxpayer, take those numbers, cut them in half. And that W-2 deduction phases in. So if you're under the $315,000, we're great. Take 20% of each trade or business income, and we move on. If you're over $415,000, then you're limited completely to the lesser of 20% of your taxable your income from that trade or business, or the 50% of W-2 wages, or the 25% of W-2 wages and 2.5%. Simplification, guys. You don't believe me. We're going to file on postcards, right? That's what they tell us. Yeah. Yeah.
Cameron,
Yes.
let's ask a question. Is there anybody that runs their employees through a PEO
Yeah.
in here?
It's a good question.
PEO is a professional employment organization like MoreSource here in town, where they're actually employed by MoreSource, and as a company, you just pay MoreSource to cover all their wages and their HR and their taxes and all that kind of stuff. No, but out of curiosity, what happens?
That's a dang good question. I mean, I'm assuming they have no W-2 income, no W-2 wages. Yeah.
So, unless you're below this 315, you don't get this deduction. It would mean you may need to reconsider how you structure your employee base in order to get this deduction.
So basically, what you're saying is it's a contract labor cost.
Exactly.
Yeah. Yeah, I know, maybe so. Jennifer just asked if people need...
So move on.
Yeah. Jennifer just asked if you guys needed a beer break. Is that... Okay.
So if you open a 503c corporation and I pay you $60,000 of my $100,000 profit because your corporation is called Keep Chris Safe
Right.
on the water, and you buy me a $60,000 boat and I get to use it, do I get to deduct the $60,000?
Well, I guess I'm a 501c3, but I think my 501c3 probably has a problem at that point. We'll see how many years we can get away with it. Yeah, that's true.
Unless it's Make-A-Wish Foundation.
Yeah, that's right. Yeah, yeah. All right. You know, the good news is, guys, we're halfway through the slide. Okay. So here's the deal. We've gone through all of that. What type of business, though, is it that you run? Are you a specified service business? Because guess what? It depends. If you are, your ability to take this deduction is limited. And I'm going to scoot over here for a second and try to find something. I hope it's readily accessible, because this is my favorite thing that I will tell you today. What exactly, you may be asking yourself, Jeremy, is a specified service business? A specified service activity based on the committee report, thank you, is as follows. It is a trade or business activity involving the performance of services in the fields of health, law, I almost said engineering, but they got taken out of this. Health, law, accounting, actuarial service, performing arts, consulting, athletics, financial services, brokerage services, or, and this is our favorite, any trade or business where the principal asset of that trade or business is the reputation or skill of one or more employees. What does that mean? No, we are asking you, what does that mean? We don't. Do you know what that means?
They don't know what that means.
No, that's right. Congress doesn't know what that means. The early ones are easy. So if you're in law, if you're in health, you're an actuary, you're in brokerage, fine, we get that. You're a specified service activity. But that last one's going to be problematic. We don't exactly know what that definition is. And it's important because they don't want those people in those businesses to get the deduction. Because generally speaking, they're going to treat income from those type of businesses, they think those more closely approximate wages, as opposed to a return on business, a return on investment for a business. So if you're one of the specified trades or business, you don't get the deduction, except if your income falls below those income thresholds. So if you're below $315,000 of taxable income and you're a married taxpayer, we don't care what trade or business you're in, we don't care how many W-2 wages you have, we don't care what fixed assets you employ, you get a 20% deduction. But if you're over 315 and you're in one of those specified service activities, that 20% deduction phases out as your income rises from 315 to 415 of taxable income. Once you exceed 415 of taxable income, you get zero deduction. So it's going to be extremely important if you're in one of those trades or businesses to, one, make sure you actually fall under the specified service business. If we can get you out of that, that would be ideal. But if you're over those income thresholds, you lose the ability to take the deduction. Yeah. Well, may want to think of a new marketing plan. Is that the? So that's the business deduction. I'm sorry we spent so much time on that, but I mean, this is one to get to the point earlier. Was that this is going to be big? It will be big, but there's a certain amount of complexity involved in making this calculation, and we'll talk about some planning stuff associated here in a minute. Anything else before we move on from that? Yes. Yeah.
I am a sole proprietor. I file Schedule C.
Mm-hmm.
Would it be, and it's just me for now, but
Okay.
there are, I just kind of started a new part of my business that's going to possibly bring on some employees. But it's just me for now. Would it be better in any way to be an S Corp or an LLC?
For purposes of the deduction, it shouldn't matter. Right? I mean, in other words, the structure of the trade or business from an entity standpoint doesn't impact your ability to qualify for the deduction. Now, S Corp may make differences. We'll talk about that maybe later. If you're having trouble meeting the wage limitation, maybe you're over the taxable income amount, but your business doesn't pay W-2 wages. If you're an S Corp and the sole owner of the S Corp, you could draw some wages out of that. You're going to pay some payroll tax on it, but now you have a basis to take a 20% deduction against some of your income. Maybe it makes sense in those situations.
Does it matter how much income you make
From the trade or business?
from a sole proprietor or S Corp?
It does not. Where you get it's the overall taxable income. Okay. Yeah, that's where you get the limitations. But each trade or business, there's no limitation on the deduction at a trade or business level above certain income thresholds.
I'd like to go back to that.
Yeah.
Are you saying on A, I, 1,
Yeah, A1.
Run through that one more time, because you were saying 315 to 415.
Yes.
If you exceed 415,
If we're talking about A1, let's say your business makes widgets, you're not a service business,
yeah.
then the W-2 limitation completely kicks in. So for your the example we used earlier, let me think. You had $100,000 of taxable income, $20,000 deduction. You pay wages of, what did we say, 50, well, let's use a better number than that. You pay wages of $20,000. So your 50% of W-2 wages is $10,000. Okay? So it's the lesser of $20,000 or $10,000. If your income is, let's say, $365,000, halfway between $315,000 and $415,000, your deduction is $15,000. It's exactly halfway between those two limits. You don't go all the way down to the $10,000 W-2 limit. You just go part way down. So since you're $50,000 into that $100,000 threshold range, that's half, you get halfway to that W-2 limitation. Does that make sense?
Yeah, so if
Okay.
you're 415, you're down to the 10.
You're down to the 10, yes. Exactly.
If you're over 415,
No, you're just down to the 10. If you're a widget making business and not a service business. If you're in a service business, you get none.
Jeremy,
Yes.
think it may be important to point out too that the taxable income is for everything else included in your return as well, your personal return. So if you're married and your spouse gets, they're a doctor and they get a W-2 that's $500,000, then that puts that you've got taxable income that's probably pretty high. So that it takes into consideration all the other income coming into your return, not just the income from that particular business.
Yeah. All right. Kind of wondering why I do at this point now. I'm starting to question my life choices. Yeah, that's right. Well, all right. Moving on. This slide is, well, I was going to say it looks a little less threatening. It's still kind of threatening, though. If you have excess business losses, so again, we talk about trades or business. If you have flow-through businesses, you take a look at all of the income and losses and you combine them for the year for all of your businesses. If you have a loss as an individual taxpayer in excess of $250,000 for your trades or business, or $500,000 if you're married filing joint, any of that excess loss is not deductible against other income in the current year. That has to be carried over as a net operating loss, and as Laura pointed out earlier, those net operating losses can no longer be carried back. They get carried forward, and they are no longer eligible to offset 100% of your income in any given year. So again, we'll talk about this in a minute when we talk about some planning ideas. As we look at the ability to take a ton of depreciation, for example, and that's a technical term, a ton of depreciation, what we can write off as expenses in any given year for tax purposes, we have to kind of balance this, right? Because we want to reduce taxes, but if we produce losses, we just have to understand our ability to utilize those losses, and recover taxes immediately. Estate and gift, again, the only thing on this is if anyone's interested in this, we've had relatively large estate exemptions, $5 million indexed for inflation per person. So a husband and wife could die with $11 million of assets or give away combined $11 million of assets and not pay estate tax. The new law doubles that amount, so each spouse now gets $11 million that they can give away in life or at death. The problem, though, is that it's temporary, so it also sunsets at the end of 2025. So there is a piece of tax planning advice here. Yeah. Didn't say it was good tax planning advice, but your kids may love it if you've got a big estate, Yeah, anyway. All right, so that's really the main thing on estate and gift. Yeah, 11 million per person, up through 2025. And then, I'm sorry, 10 million indexed for inflation, so it'll end up being 11 million per person. Yeah, they have gone ahead and made those calculations. All right, so remember I said there was a challenge? All right, we kind of went through the challenge as it relates to this new tax bill. There is a lot to unpack. And the depressing thing is we probably could have talked about that for another 6 hours and still not gotten everything in the bill. All right, so now what do we do? All right, that's the goal. What do we do with this? And the thing to keep in mind, we kind of hinted at it earlier, is that tax planning has to be a multi-year optimization. Our job is not to look at your situation and reduce tax as much as we can in the current year to the detriment of future years. It is to balance income and expenses between given tax years and try to produce the lowest overall tax result, again, also keeping business considerations in mind. That's what we're supposed to do. Now, the problem, this isn't new. You know, what we're talking about isn't new, but I think it takes a little bit more focus now because of the fact we have new tax provisions. Those are going to interact with old tax provisions. They're going to interact with each other. And oh, by the way, we may not have guidance on all of those yet. In addition, we're back into this expiring provision world. All right, so what do we do? So let's start with our favorite topic. Let's take a look at this one more time. As it relates to the qualified business income deduction, the one thing I didn't mention was that wages, I think I implied it, but didn't really explicitly say it, wages and guaranteed payments. So if you're a partner in a partnership and draw a guaranteed payment, or you're an S-Corp owner and you draw a W-2 wage, that income is not subject to the 20% deduction. Okay? Your flow-through business income is, your share of the profits are, but that income is not. So before, when we've advised S-Corp shareholders, we've always, you know, unless there was some other mitigating reason to do otherwise, we recommended business owners pay themselves the lowest amount of reasonable compensation they could to save on payroll taxes. That doesn't change under this, and it actually becomes more important because the W-2 wages you draw from the business are not subject to the 20% deduction, but your flow-through business income is. So just something to keep in mind. If you're near the income thresholds, we're back to that time-honored tradition. Defer income and accelerate deductions to get yourself under the $315,000 of taxable income. Because as we've seen, things get a heck of a lot simpler if you're under that limitation. These are just some items. Depreciation. You know, again, we have the ability to write off a significant amount of fixed asset cost in the year of purchase. For goodness sakes, let's use that if we can. But if we create operating losses, we have to understand how long it's going to take us to recover or to utilize those net operating losses to get tax benefit. Maybe it doesn't make sense to trigger all of that depreciation expense. Again, we have to look at it over multi-years. Itemized deductions, we'll talk about bunching. Laura will talk about this in a minute as well. You know, again, it gets based on taxable income, you know, those limitations. So to the extent maybe we double up on some itemized deductions in 1 year to get below the threshold, maybe that makes sense. Maybe that optimizes our tax situation, you know, over a 2-year period. Maybe we take standard deduction 1 year, bunch our itemized deductions another year. Retirement plan contributions, you know, those are big from all sorts of reasons, from, you know, employee recruitment and retention to retirement planning, but they're great for tax planning. You know, are you maximizing the use of your retirement plans in your business? Using that as a vehicle maybe to get taxable income down below the thresholds. And then finally, we just mentioned here, you know, as Laura mentioned, we have the ability for more taxpayers to use the simplified method of accounting. To the extent you're a cash basis taxpayer, it's easier for you to manage income between tax years. All right, if you're a non-service-based business and you're subject to that W-2 limitation, this gets back to the conversation we had just a few minutes ago, and maybe the W-2 limitation is going to be a problem. If you're an owner in an S corporation, do exactly the opposite of what I just told you 2 minutes ago, and maybe think about drawing an additional wage out of the business so you can get the deduction on some of the income. Now, that only works in an S corp. If you're a partnership, you know, or a sole proprietorship, you can't draw a W-2 wage, so that doesn't work in that situation. If you're in a service-based business, that income limitation is really important because it may cause you to not get the benefit of the deduction at all. So again, look at ways to manage income below those thresholds, or if our trade or business has some service component and some non-service components, think about spinning off the non-service-based business from the service-based business so that at least that income would be subject to the deduction. And then finally, we just bring that up, this whole idea of trade or business. We keep mentioning these deductions are related to trade or business income. If I quizzed you, what exactly is a trade or business? Same thing. What exactly is a trade or business? That's something the IRS hasn't properly defined. So again, if you've got a rental business that operates, you know, triple net lease, you have someone else that manages the property, is that a trade or business? Maybe. It's not clear. Now, we do know they probably want rental businesses to take advantage of this, or otherwise they wouldn't have put that 2.5% of capital asset limitation in. That came in late, and it was to help real property trades or businesses or rental businesses. But again, just something we're going to have to keep in mind is making sure, are we going to be fighting with the IRS over what qualifies as a trade or business? All right, I think I've done enough damage here. I'm going to turn you back over to the capable hands of Laura, and we're going to talk about some other planning ideas, particularly as it relates to itemized deductions and the like. So,
okay, so for the itemized deduction planning, so we indicated that the standard deduction went up, and then there were some itemized deductions that were either limited or completely went away. So there is some opportunity there still for planning, and most of it, it's kind of optimization for if you are going to take the deduction or take the standard deduction or itemize in that year. It will be more difficult for most people to itemize. I mean, I've heard a lot of numbers out there, but I think, it's like 80% or something are still going to be not itemizing and will be taking the standard deduction. So most people, it kind of pushes them out because the $24,000, which is greater than what it was in previous years. So we'll be more likely to take the standard deduction than itemize. However, there are some opportunities. So charitable contributions, so group contributions. So consider timing and double up every other year. So now that they've increased the limit there, number one, and then so you could maybe make all of your for a 2-year period, make them all in 1 year. So say you normally gave $15,000 a year in charitable gifts, but now that alone may not be enough to put you above that $24,000 to take advantage of the standard or of itemizing. So if you were to give $30,000 in 1 year, that puts you above the $24,000 standard deduction and makes sense, and then you would get that optimization for itemizing in that year. And then the following year, you wouldn't necessarily do the charitable giving in that year, and so in that year, you would take advantage of the $24,000 standard deduction. So an option for the timing of when you give the gifts. There's donor advised funds. So if you're a large giver as well, a donor advised fund allows you to give in 1 year to a fund and say you want these funds to be distributed in the next 5 years in this way. And correct me if I'm...
Yeah, it's a way you can jam a bunch of deductions in 1 year, but you don't necessarily have to decide which charities get the funds until some future time. So again, it kind of works well with that grouping that you.
And in that one, I think the charitable organizations are a proponent of, because in the way that I first described it, where you're giving 1 year, not the next year, and then the next year, those organizations are not getting those donations in a year. So which is not, if you're doing it in the giving spirit and not in the tax deduction spirit, then that's not necessarily what you would want to do, but providing that in a donor advised fund kind of alleviates that issue. Giving gifts of appreciated stock is another option to do there. Direct contribution of an IRA to a charity, those are options as well. And always something to think about, especially in the business, within your businesses, if you are making charitable donations in your business, always thinking about whether those donations are actually charitable contributions or sponsorships or marketing advertising. So if you're like a sponsor in like a golf tournament and there's signage, that's a sponsorship, even though all of those funds are going to that organization, it's a sponsorship and is 100% deductible. So versus where if it were a charitable contribution, it still would be subject to that 60% limitation. Are there any questions on that? Because I feel like some people ask a lot sometimes on that one, and whether or not, what's a sponsorship and what's not. And then the state and local income tax deduction. There are Missouri credit programs to convert state tax payment into charitable contributions. And I don't know a lot about that program.
That's something we're looking into at a wide range, but there are always, opportunities for charitable deductions like food pantry or, rape and abuse crisis centers. Sometimes, they've got neighborhood opportunity credits. Maybe, people like those because it allows you to give more. Your after tax cost of giving is reduced, but that also has the other benefit of that is it's taking what would otherwise be what would otherwise be a state tax payment. You've made a charitable contribution, which if you're itemizing and subject to limitations on your ability to take state tax payments, you're already over the 10. Maybe you get the benefit of the charitable contribution and it comes with a 50% tax credit. You wouldn't get the benefit of the 50% payment before. So I think those will be more important, although, they always keep talking about reducing the amount of credits available to the state. We'll see, but I think those become even more valuable in this case.
All right, so back to some of the business planning opportunities with depreciation. So, like Jeremy mentioned, we like a crap ton, or was that a crap ton?
I don't think, yeah.
So we have the ability to write off a significant asset purchases. So there's the Section 179 and bonus expense that lets us essentially write off 100% of the cost of the asset. And it's important to note it's not prorated. So even if the assets are purchased at the end of the year, so if you purchase the asset in February or you purchase the asset in November, it's a $50,000 asset, the entire $50,000 would get expensed in that year. It's not prorated based on the timing of the purchase in the year. Now, if you were to make it in December 2017 versus December 2018, that's something to consider as well. And kind of in this one, we always go back to all asset purchases all the time should be driven by business needs. It's never, your number one is not like, I need to buy an asset in order to get the tax deduction for that. A lot of people, sometimes that is a thought process that happens, but you don't want to be buying things that your business doesn't need. So that's one thing we always try to push to make sure people always know that, make sure it's something that's necessary for your business and needed by it as well. So the NOL limitations, so we touched on that already as well. We can expense a lot, but remember we are limited to 80% of our taxable income. So we can't offset everything. So we're going to have 20% of that that's subject to tax. So we don't want to create a loss that we're just going to be building up with these losses and we're going to never recognize them completely. Cost segregation study, if you're unfamiliar, that would be like if you put a new building into service, there are a lot of components of that building. So you would try to break that up into certain items that are shorter class lives. So a building's typically depreciated over a 39-year life, and you would take that depreciation over a 39-year period. However, you could pull out certain pieces of that are actually could be depreciated over 5 or 15-year lives. And so you could expense those quicker. However, when you do that, you're going to be potentially pushing more depreciation into your current year and in closer years, which would decrease your income, and potentially if that's going to be making NOLs in that regard too, you want to watch out for that as well. So that's where that cost segregation comes into play. And then entity choice. So we had a question on that a minute ago, and this more relates to, so people hear the C Corp rate, 21%. That sounds pretty great. So should I become C Corp? Now that I've been an S Corp for a while, should I be thinking about going back to a C Corp? I'm just an LLC. Should I be considering going to a C Corp instead of an S Corp? Our general response to this so far from the analysis that we can see here is probably not. Do you plan to distribute net profits? So the C Corp, the thing that kind of gears everybody away from that is the double taxation. So you're taxed on that business income, and then when you take dividends out of that business, you're taxed on the dividends of those business. So that's where that double taxation comes into play. So if you're going to be taxed at that 21%. So in this one here, the second one, you're taxed on the 21% from the net profits of the business, and then you're going to be taxed on the dividends paid as well, and this kind of calculates. So the total tax rate for a C Corp is going to be 39.8% overall, after you've got the 21% plus being taxed on a 20% rate, basically, from the dividends taken out of that. And then, but if we look at in this case of the flow-through, you would have the highest, we're using the highest individual rate for the example, 37%, and then an 80% because we get that 20% deduction, so 20% off that net that you had, we're only at a 30% rate. So in that example, pretty straightforward, using the highest individual rates and the corporate rate, taking out all the net profits from your C Corp, the answer is still the pass-through. Another example here is kind of at the other end, it's like the highest. So let's assume taxable income, you're above those thresholds that we talked about. You're full phase out of the QBI. So tax rate on pass-through income, 35%. Tax rate on corporate income, a little lower, but 35, 85. So still less to be on the pass-through income. So we've been getting that question. It's like, so I should become a C Corp? And the initial response is probably not. There will be situations, given other income, capital gains, how things play out, that could affect that. But most situations that we've been looking at and analyzing so far say that's not the case. And then the gift and estate tax planning, fewer estates are subject to tax, but like we said, the change is temporary. It does sunset in 2025, and we don't know what will come after that. So we're just really, as much as we do on that one.
You have to assume if you've got people that, if you're looking at planning, you just have, especially if they're younger, you just have to assume they're going to live past the expiration date, no pun intended, of the of that law. So we're going to be under the 11 million most likely. So it doesn't change a whole lot.
Yeah. So any questions at all for myself or Jeremy? We might have not even touched base on it. We're happy to answer anything that you might have. Everybody's just ready for a drink. No more woohoos. We only had the one. So.
Yeah, I killed the woohoos. I'm sorry.